Let's now quickly revise the topic of dissolution of partnership. This is unit 6 of your chapter 10, which deals with partnership. In fact, the last unit of your partnership chapter. What do you mean by dissolution? That's going to be our first topic. And the second topic will discuss circumstances which leads to dissolution. Third topic will be consequences in the process of dissolution. Topic 4 will be refund of premium. Topic 5 will be closing of partnership by way of passing journal entries. Topic 6 will be consequences of insolvency of one of the partner. Topic 7, your favorite case law, Garner versus Murray, insolvency of one of the partner, also insolvency of all the partners, that is insolvency of firm. And in topic 8, we'll discuss piecemeal, which is again two parts, piecemeal in the case of maximum loss and also the other method, which is highest relative capital method. And lastly, we'll discuss how to account for dissolution of limited liability partnership. Without wasting much time, let's quickly begin with topic 1, introduction of dissolution of partnership. The definition is given under section 39 of Partnership Act, which says that dissolution of a firm means that the partnership between all the partners of the firm is dissolved. I want you to note very clearly, dissolution of partnership is different from dissolution of partnership firm. If it is dissolution of partnership firm, assets of the partnership firm are sold, liabilities are paid, excess money remaining after paying liabilities will be paid to partners. If in case the amount payable to partners is less, amount available is more, we pay that excess money to them, surplus, profit. If in case the amount available is less but their capitals are more, we will give that shortage money and ask them to adjust, realization, loss. Either ways, in the case of dissolution of partnership firm, we sell all the assets, pay all the liabilities and settle the capitals. This is different from partnership dissolution. In the case of partnership dissolution, only the agreement between the partners will get cancelled. A new agreement will come. Admission, retirement, death is dissolution of partnership. Because one of the partner goes out, one of the partner comes in or one of the partner dies, the existing agreement is no more valid. They would have to enter into a new agreement. New partnership deed comes into place. That is dissolution of partnership but not firm. Why? The business will still continue under the new agreement. Whereas in dissolution of partnership firm, we sell the assets, pay the liabilities, settle the capital. Basically, the business comes to an end. Business will not continue. In the case of dissolution of partnership, that is reconstitution of deed, we prepare revaluation account. But in the case of dissolution, we prepare realization account. I hope you have understood topic 1. Let's move to topic 2 of our syllabus. Topic 2 of our syllabus talks about circumstances which leads to dissolution. What are the situations because of which a partnership firm will be dissolved? This is given under section 40, 41, 42, 43 and 44 of Partnership Act 1932. Section 40 talks about agreement. If the partners mutually agree to dissolve, they all say, hey, yeah, come on, yeah, it's enough, we'll wind up the company, we'll wind up the partnership firm. That is section 40, by agreement the partnership firm can be dissolved. Next one is compulsory dissolution. The business that you are doing, the product that you are selling is now legally banned. Let's say you are manufacturing e-cigarettes and government told no more e-cigarettes manufacturing. You are dealing with crypto, government banned crypto. In that case, your business will get wound up. That is not voluntarily or by agreement. That is given under section 41, which is compulsory dissolution of partnership firm. Then comes on happening of certain events. This is given under section 42 of Partnership Act 1932. If you created partnership firm for a specific period, let's say 6 years, once 6 years is over, firm will get dissolved. If you created partnership firm for completion of a specific venture or a specific project, I have the land, you have the money in my land to construct the building, both of us will make one partnership. Once the building construction is complete and that flats are sold, our partnership firm is dissolved. So on completion of a specific venture, and in the case of death of a partner, it is always usually dissolution of partnership firm unless they immediately enter into a new agreement, because you cannot have an agreement with a dead person. If the agreement has 3 people's name, one of them is dead, that agreement is done. You have to immediately enter into 2 people remaining. You should enter into a new agreement, because the old agreement is now not in force anymore, because it involves a dead person. You understood? In that case again, it is almost like dissolution of partnership firm. When you say dead, it might be clinically dead or it might be financially dead. Clinically dead means stopped breathing, heart stopped. Financially dead means money is not there in the pocket. If someone doesn't have money, they'll be treated like dead body. You tell no, hana illadironu henakke samana. If someone doesn't have money, they'll be treated like dead body. People ignore, they don't care about you. Like that, if you are dead clinically or if you are dead financially, then the partnership firm in which you are a partner is dissolved. Firm is dissolved, not just the agreement. Unless that continuing partners will enter into a new partnership agreement. I am not telling this. Section 42 of Partnership Act 1932 is telling this. Then we have notice by partners if it is partnership at will. When we entered into partnership, we have not decided any specific term. We have decided to keep the partnership at will. Till the time we want to continue, we will continue. That is partnership at will. If it is partnership at will, by way of written notice, if one of the partner proposes dissolution, the firm will get dissolved. Last one is order of court. If some of the partners have gone crazy, mad, or permanently disabled, met with an accident, 80% of the body disabled, 20% only functioning. You can't be partner in a firm, no. What will you do with the 20%? You can't even get up and go to washroom. Sad. In that case, the firm need not continue. Or one of them has done willful misconduct. Beku antane tappu. Intentionally they have done some crime or breached the terms of the agreement. They have had a non-competence agreement. No one will compete with the firm. I am a partner. I have created one more sole proprietorship which is competing with the partnership firm. That's against the agreement, no? So again, if you do any breach of agreement or willful misconduct, unsound mind or permanently disabled or ನಾಯಿಗಳ ತರ ಕಿತ್ತಾಡ್ತಾರೆ, partners are fighting so crazily that court will tell better off you are not partners. I am telling you dissolve the partnership firm. I can't see you people fight. So in these cases, court can give an order forcing the partnership firm to be dissolved. That is under section 44. On this a theory question or a short notes question can come. I give a small acronym to remember this, a dead cow. What is the acronym to remember? A dead cow. Agreement, death, expiry, adventure completed means venture completed. Add you forget, okay? It's venture completed. Dissolution by court order, compulsory dissolution or on notice or with consent. So this is the acronym to remember. If in case it comes up for a 4 marker or a 5 marker or a 6 marker question. No need to remember the section number, not mandatory. But if you know it, it's good. Can we proceed to next one? By this we finished topic 2, which talks about topic 2 we finished, that is circumstances leading to dissolution. Now we'll discuss topic 3, which is consequences and rules of settlement. So the accountant is here, 3 partners are there, 3 partners are asking, sir, we want to dissolve the firm, how to dissolve? Then the accountant will tell, very simple. First you sell the assets. Step 1, realization of assets. Step 2, payment of liabilities. When you say liabilities, at first you pay outside liabilities. After you pay outside liabilities, with the money that is left, you will pay partners, loans and advances. So step 1, realization of assets. Step 2, payment of liabilities. Step 3, payment of partners, loan and advance. What partner has paid to the firm over and above his or her capital. After that, leftover money will be used to pay capital. If money payable towards capital is less, money available is more, we pay extra, surplus or profit. If the money payable towards capital is more, money available is less, we won't pay some money, we will pay lesser money. That is deficiency or loss in realization. Any realization profit or realization loss, surplus or deficiency, by default it should be shared between the partners in profit sharing ratio. It should be shared between the partners in profit sharing ratio. There are exceptions. Insolvency, we'll discuss that separately. By default, any surplus or any deficiency should be shared between partners in what ratio? Profit sharing ratio. This is given under section 48 of Partnership Act 1932. And I've given you the entire what loss is also. You get this? People who are watching it online, if at any point of time you would want this PDF what I'm using, you can search for the link in the description and that will give you the entire notes of whatever we're discussing with the answers, true or false and everything together. Yeah, and also let me know how did you like the material whenever you use it, and all the best for your exam. Let's continue with topic 4. Topic 4 talks about refund of premium. I'll tell you what is the case of refund of premium. I am a partner, I became a partner in your firm. When I was admitted as a partner in your firm, You asked me to pay some premium, like goodwill, extra money. I told you, why should I give you goodwill? You told your partnership will survive for next 10 years. 10 years I'll make profit. So you're asking me to pay upfront some premium to enjoy the benefits for 10 years. I agree. Let's say I pay 10 lakh rupees and you promised me that the partnership firm will be there for how many more years? 10 years. And I'm supposed to get profits. So you promised me 10 years of profits and firm. So I have paid you 10 lakh rupees now and I became partner in your firm. After 3 years, you are winding up your firm. That's sad, no, for me. After 3 years, if you wind up, I paid premium for 10 years. I would have paid only for 3 if in case you are told this. I paid 10 lakh rupees assuming that the firm will stay for 10 and you promised. Now after 3 years, you are winding up the firm. I will say, Avela Gotila, give me back my money. I will ask and the firm might have to pay sometimes. If the firm has to pay, that is called refund of premium on premature dissolution. This is regulated by section 51 of Partnership Act 1932. When will this happen? When I was admitted, I paid premium. Point number 1. Point number 2, you have promised me a fixed term. Point number 3, firm is getting dissolved. Point number 4, firm is getting dissolved not because of me. If the firm is getting dissolved because of my misconduct, because of I want to discontinue, I want to retire, then in that case, it won't be refunded. If not for my mistake, firm is getting dissolved, I was promised the term and I have paid the money, then I can claim refund. That's regulated by section 51. See this? When a partner joins a firm for a fixed term and pays a premium, which is extra amount, to existing partners for admission, and that amount is normally non-refundable. But if the firm is dissolved before the agreed term, we agreed for 10 years, you are dissolving the firm in the end of 3rd year, then you may have to give me the money. Why have I told the word may? There are conditions. What are the conditions? It should not be because of my fault. And in the agreement of the deed, partnership agreement, if you have written that in no case the refund will be made, then again I won't get. Why? I signed no. You understand? So may be refunded proportionately. What are the conditions? Without my fault, the firm should be dissolved. And it should be dissolved before the end of the term. You promised 10 years. 10 years is over. Can I ask refund? No. And no agreement to the contrary. Meaning, I gave you 10 lakh rupees, but in the agreement you wrote that in no case the firm will refund the premium. Then I won't get it back. Are you getting it? So number 1, not because of my fault. Number 2, premature dissolution. Number 3, there is no agreement saying that it will be not refunded. In that case, I can take it. No refund when it's because of my misconduct. No refund when I am pushing the firm to be dissolved or I am retiring. No, a refund when the firm is getting dissolved because of death of a partner, or no refund if agreement says that we should not be refunding that money. Same thing I have given it in 2 different languages, but I hope you understood. This is the topic of refund, which is topic 4 of our chapter. I have given the exact same section 51 extract also if you want to. And a lot of times if you read this one-liner, it will help you remember the entire concept that we have read. We did a question where refund will be given, where it will be not given. We did true or false also on this. Then we'll go to topic 5. What is topic 5 in our chapter? Closing the books of the partnership firm. How to close the books? Closing of the books is done by way of realization account. Done by way of realization accounts. Again, this is also section 48 only. That is, sell the assets, pay the liabilities, pay the advance of the partners, then repay the capital. Same thing, but in this topic we are learning accounting entries. What to do in the beginning? First, close all the asset and liability accounts by transferring them to realization. How do you close it? Asset will usually have debit balance. If you have to close it, you would have to credit the asset. Debit will be realization. Entry will be realization account debit to asset. If in case you want to close the liabilities, what will be the entry? Liabilities will usually have credit balance. If you want to close them, you would have to debit. Entry will be liability account debit to realization. After this, you will sell the assets. When you sell the assets, you receive cash. Usually for sale of asset, entry is cash to asset. Here we won't credit asset. Why? Asset is already credited by rating to realization. So on the sale of the assets, write the entry as cash account debit to realization account. Cash account debit to, this is the entry for sale of assets. When you write this entry, ignore sale price, book value comparison and profit accounting. Just write this entry cash to realization for sale price. Write the entry cash to realization for sale price. Don't try to account profit separately. Profit will be found for sale of all the assets, settlement of all the liabilities together at the end. Next one, if in case liabilities are paid, what is the entry? Usually entry is liabilities to cash. Here we won't debit liabilities. Instead of debiting liabilities, I'll debit realization. Entry will be realization account debit to cash or bank. After that, what if any of the asset is taken over by partner? We should pay the cash to partner. Instead of we paying cash to partner, he takes over our asset. So we don't have to pay him so much money. His capital will decrease. Entry will be partner's capital account debit to realization. Partner's capital account debit to realization. What if liability is taken over by partner? See, we are supposed to pay cash. Before we pay cash, he has taken over the liability, meaning he paid cash to the liability. So we have to give money to partner now. So partner's capital will increase. Credit partner's capital. Debit realization. Entry will be realization account debit to partner's capital account. Then dissolution expenses. To sell assets, to settle liabilities, it might not be an easy task. We might have to incur some expenses. Brokerage, stamp duty, transportation, legal paperwork, all of that. If in case we paid any of that, any expense or any income, any profit or any loss arising in the process of dissolution will be always returned to realization account. Entry will be realization account debit to cash. What if the same realization expense is paid by partner? If partner pays, I will not write entry. Will the firm write entry? Firm will like, no, I will not write. But if the partner has paid and we are supposed to pay partner, then we'll write entry. If partner has paid on our behalf and we don't have to reimburse, then no entry. If we owe that money to partner, partner's capital will increase. Credit partner's capital, debit realization. Entry will be realization account debit to partner's capital account. Everybody got this? What if there is profit in the process of realization? Any profit on realization will be transferred to partner's capital account. Any loss on realization also will be transferred to partner's capital account. Profit credit to partner's capital because it will increase. Loss debit to partner's capital because it will decrease. What is the entry for profit? Realization account debit to partner's capital. Entry for loss? Partner's capital account debit to realization. I hope everybody understood the accounting entries. If you prepare ledger out of this, this is how it will look. When you transfer assets, realization to assets. When you transfer liabilities, by liabilities to realization. When you sell the assets, cash to realization, here you will write by cash. When you settle liabilities, realization to cash, here you will write to cash. Instead of you receiving the cash, if the partner has taken over, credit partner's capital account here. If partner has paid a liability, debit side will write to partner's capital account. And ultimately you find profit or loss. Excess of credit over debit will be profit share to partners. Excess of debit over credit will be loss share to partners. I hope everyone understood. All the assets will be transferred to realization except cash. Cash will open one separate ledger. All the liabilities will be transferred to realization except capital and reserves. Capital you write to partners capital. Reserves you share to partners. If in case there is P&L account debit balance or any other accumulated loss, don't transfer to realization. Transfer to partners capital account in profit sharing ratio. Cash receipts and cash payments will be recorded separately. Don't net them off. I have received this much, I have paid this much. Netting amount is not allowed. And don't even net off debtors and provision. Let's say in the balance sheet asset side there is debtors 10,000 in the inner column minus provision 1,000, 9,000 in the outer column. What do you have to do? Debtors is 10. When you transfer assets here, transfer 10. Provision 1,000 you transfer as a liability separately. I hope you got it. Then don't try to identify profit or loss on sale of assets or settlement of liabilities individually. Profit or loss for the entire realization process is identified as a lump sum, whole amount at once. I hope everybody understood this. Fantastic. That's how you prepare your realization account. Last point to note, if nothing is mentioned, assume asset realizes 0 rupees. If nothing is mentioned, assume liability is settled at book value. Usually they will mention all the asset sale price. all the liability settlement price. If they don't mention, assets are sold for 0 rupees, liabilities are settled at book value. Why? Conservative approach. What is this? Very nice. Then we did set of questions on accounting entry. I gave you an acronym and I also made you do some true or false questions on that. Now, extension of topic 5. Topic 5 extended, we'll discuss joint life policy. What is joint life policy? It is the policy taken by the firm on the lives of the partner, so that if the partner dies, policy matures, insurance company will give us money and that money will be used by the partnership firm to pay the partners. This is same thing what we read in admission, retirement and death. What you have to remember is policy will not mature if the firm dissolves. Policy will mature only if the partner dies. So in the case of dissolution of partnership, at the time of dissolution, what will happen to JLP? JLP will be surrendered. JLP will be, now there are two possible cases. One, JLP is already there in the balance sheet as asset. Two, JLP is not there in the balance sheet as asset. So why and how will JLP appear in balance sheet? You have two treatments. No, you would have written admission, retirement, death. If JLP premium that you pay is treated as expense, it will go to P&L expense. It will not come in balance sheet asset. If JLP premium that you pay, if it is treated as asset, then it will come in balance sheet as asset but at surrender value. Let's take first case. Joint life policy premium paid is treated as asset and it is shown in the balance sheet on the asset side. What to do in the process of dissolution? Simple. Treat it like just another asset. Any asset in the balance sheet, what do you do in dissolution? Transfer it to realization. Entry will be realization to asset. This also same. JLP asset at surrender value in the balance sheet will be transferred to realization by passing the entry realization account debit to asset account. What is the name of the asset? Joint life policy. Understood this? After this, this policy will be surrendered because firm is only not there. Policy itkondu en martira. Insurance company will give you surrender value. This is nothing but sale of asset. What is the entry for sale of asset? Cash account debit to same entry. Cash account debit to realization. You wrote the same entry that you pass when you sell the asset. Are you getting it? Sir, I did not sell the asset, sir. My partner took the JLP policy. He told he will surrender and he will collect cash. Entry will be same like asset taken over by partner. What is the entry when partner takes over the asset? Partner's capital to realization. If we sell, cash to realization. If partner takes over, partner's capital to realization. If joint life policy is taken over by partner, entry will be partner's capital account debit to realization account. What is the entry? Partner's capital account debit to, very good. Then what if the policy lapses? You have done some breach of agreement. Policy will lapse. Insurance company will not give surrender value. Then two treatments. One, transfer the asset to realization but no cash realized. Leave it there. Or instead of transferring to realization and not receiving any cash, instead of writing realization to asset, straight away write partner's capital to asset. What is this joint life policy here? This is asset. This is asset account. I'll write JLP. Shortcut, easy for you to remember. If the asset is getting sold, there is a point in transferring to realization. If it's going to realize nothing, you can just write partner's capital to asset and close. Writing off the asset directly to capital. Or if you want, you can write realization to asset but don't write any cash to realization entry. Either ways it is same. But ICI usually follows the approach of writing partner's capital to JLP when it is written off. There was a question on this in the chapter of dissolution of partnership firm when this chapter was in CA intermediate before May 2024. Ever since May 24 when it has come in foundation, there is no question on this value, this transaction. But anyways, I'll just tell you, keep you prepared. One fine day institute wants to make paper difficult and they put this adjustment, you still know how to do it. Lastly, what if there is JLP reserve in the balance sheet? Don't get worried. Treat it like just another reserve. What is the treatment of any other reserve? Share it to partners in profit sharing ratio, general reserve. Same thing you do here also. Reserve will have credit balance. Debit the reserve. Credit partners capital account. Entry will be joint life policy reserve account debit to partners capital account. Share that JLP reserve to partners in what ratio? Profit sharing ratio. Everybody got this? Fantastic. So by this we are done with topic 5. Can we go to topic 6 now? Topic 6 of our dissolution of partnership firm talks about consequences of insolvency of partner. Meaning, if any of the partner becomes insolvent, what to do? To begin with, we'll understand what do you mean by insolvency. It is not randomly one person is called insolvent. To be calling a partner insolvent, number 1, there should be realization loss in the partnership firm. What should be there? Realization loss. That realization loss, when you charge it to capital, when you debit it to capital, capital becomes negative. And that capital becomes negative means capital has debit balance. A partner has to pump in cash to make his capital good. But to bring a cash, he has to sell personal assets. If he sells his personal assets, they are not sufficient to pay his personal liabilities only. If he sells his personal assets, it's not sufficient to pay his personal liabilities. Then we call a partner as insolvent. So remember the order. Number 1, loss. Number 2, loss has made capital negative. Number 3, he does not have money to pay. Meaning, if he sells his private assets, it's not sufficient to pay his private liabilities. How can he pay money to firm? That's when partner is called insolvent. Are you getting it? Basically, when you sell all the assets and you start paying liabilities, there is no enough money to pay liability. Liability will be discharged only when the partner brings cash. But for the partner to bring cash, he is not RBI to print cash, and in his home there are more liabilities than asset. He has to pay more money than the assets that he has. His personal debt only is not able to pay. How will he pay partnership firm's debt? That's when we call the that's when we call the partner as insolvent. Did you understand this? He has to pay, but he has nothing to pay. See, a partner is said to be insolvent when he cannot pay his debts in full, his capital shows a debit balance, then his insolvency, the money what he should bring but he cannot bring, will be borne by solvent partners. It will be borne by, firstly, as per partnership deed. If partnership deed doesn't tell how to adjust it, then we'll go to Garner versus Murray case. First we should apply what? Partnership deed. If partnership deed says something, follow that. If deed doesn't say anything, then we'll apply Garner versus Murray case law. You understood this? This is basically told by section 45 and section 49 of the Act. I made you understand when is it deficiency, when is it not deficiency and everything. We'll however cover that in the next case. I want you to come to the next part. Debit balance doesn't mean insolvency. Did we discuss this? If there is realization loss and that loss, when you deduct it from your capital became negative, but you have enough cash privately to bring in and then make your capital good, then is it insolvency? It is insolvency when your capital is negative and you don't have money to make it positive. Firm has loss. Loss makes your capital negative. You have money in your pocket. You might have made loss, but you are not insolvent. You have loss. You don't have money also. Then you are insolvent. I gave you a small box. Understanding debit balance and insolvency are not same. Debit balance idre insolvency agbodu. Debit balance idagella insolvency alla. Did you understand this? Very nice. We discussed this part. Then we went in to discuss when is he insolvent, when is he not insolvent, how to deal with deficiency and everything. Then one important point I told her, if in case insolvency has happened because of his own misconduct, other partners will not bear your loss. Rama, Bhima, Soma are partners. Soma became insolvent. Soma's insolvency is borne by Rama and Bhima. But if Soma becomes insolvent because he did gambling, he did Dream 11, he did some gaming app mein full money woodies, he played Ludo, he played online rummy, he wasted all his money, then Rama and Bhima will not bear Soma's loss. Insolvency of a partner is borne by the solvent partners if it's not because of willful misconduct or breach of agreement. Understood? Then we went into topic 7. Wow, my favorite. Garner versus Murray. It's a case law what happened in 1904 in English country, not here, in England. Now, when will you apply this? Point number 1, partner should be insolvent. Insolvent means loss, negative capital, no money to bring. Loss, negative capital and no money to bring. That's when he is insolvent. So, partner should be insolvent. and only one partner should be insolvent, or not all the partners should be insolvent. One of the partners should be insolvent, or two also, but not all the partners should be insolvent. And the next important condition is basically you cannot bring cash to fulfill its deficiency, and partnership deed is silent. Partnership deed is only then will apply Garner versus Murray. What if Rama, Bhima and Soma are partners and they have a partnership deed, and in that partnership deed it is told what to do if one of the partner is insolvent? Then we will go to Garner versus Murray. No, we will do what partnership deed tells. Only and only if partnership deed is silent, then we will apply Garner versus Murray case laws learnings. I hope everybody understood. So the next thing for you to note, how to apply this? Very simple, yeah. If in case there is loss, that loss will be borne by them in profit sharing ratio. The argument in the case of Garner versus Murray was very simple. The argument says that the insolvency of one of the partner power issues. Now it's restored. Insolvency of one of the partners is not operating loss, it is capital loss. Operating means you buy inventory, you sell inventory, you buy goods, you sell goods. That loss is operating, profit sharing ratio. But if the loss is capital in nature, it should not be shared in profit sharing ratio. It should be adjusted in capital ratio. That's the argument. Why did this come? Very simple. Garner, Murray and Wilkins, three of them were partners. Garner, Murray, Wilkins, three of them were Bejan business madadru. Wilkins became insolvent and Wilkins capital at 263 pounds deficiency, and both of them, Garner and Murray, have capital as 500 pounds and 300 pounds, but their profit sharing ratio is equal. Garner is telling this 263 pounds deficiency of Wilkins, we both, Garner and Murray, will share 1:1 ratio equal. Murray is like, adengagatte. This is not revenue loss for us to share equally. Let's share in the ratio 5:3, capital ratio. They both went to the judge. Sorry, they both went to the lawyer. Lawyer looked into the partnership deed. Partnership deed did not tell anything. Then what happened? Partnership deed was silent, no. Then the lawyer told it is debatable. It can be 1:1, it can be 5:3. Then Garner appointed a lawyer who told 1:1 because yes, he can bear less loss. Murray appointed a lawyer who told no, it should be 5:3. I should get less loss, you should get more loss. And they both went to the court. The judge gave the decision saying that this is not revenue loss, this is capital loss. So the deficiency of Wilkins 263 should be borne by Garner and Murray, not in the profit sharing ratio 1:1, but in the capital ratio of 5:3. But the judge gave couple of other points also. Judge gave couple of other insightful points also. Judge told if the solvent partners has to bear the insolvency of the other partner, these partners should have credit balance in their capital. Understood? Only then they can bear. What if Garner had debit balance in his capital? Then the entire insolvency of Wilkins should be borne only by Murray. That was the judgment given there. Ever since 1904, we are following the same case law even today. But remember, this is not applicable if the partnership has a deed. You understand? I'll share another beautiful video on discussion of this case separately, but for now that was the overview. Now quickly come back. So when do we apply Garner versus Murray? When the partnership deed is silent. So when the partnership deed is silent, partner is insolvent and he cannot bring money, then how will we adjust it? Solvent partners with credit balance in their capital account. Who? Solvent partners with credit balance in their capital account will bear the insolvency in capital ratio. Solvent partners with credit balance in their capital account will bear the insolvency in capital ratio to the extent they have capital, not beyond that. So that was the discussion here. When we say capital ratio, which capital ratio? Depends upon the capital system followed by the entity. If the firm follows fixed capital system, fixed capital is there, no, that ratio. If the firm follows fluctuating capital, capital just before dissolution, capital just before dissolution, before starting with dissolution process, whatever is the capital, that capital ratio has to be taken. Am I right? This is not applicable when one of the partner does misconduct. This is not applicable when all the partners becomes insolvent. When all partners become insolvent, we don't pay only. That's our next topic for discussion. That's called deficiency. We'll discuss that next. So I hope you understood this. This case law will not be asked in the exam. This is beyond books. Certain place I have given beyond books, meaning that's not required for exam, but I've just given it so that you know. True or false discussion also we did on this. Then capital computation I have given small theory. I explained it to you how to do. Then we did some small questions where you need to apply and also pass accounting entry. What is the accounting entry to adjust the insolvency of one of the partner? Very simple. Insolvent partners capital deficiency you credit and debit it to the solvent partners in capital ratio. For example, if Soma is insolvent, credit Soma and debit Rama and Bhima in what ratio? Capital ratio, to the extent they have credit balance in their capital account. That's applying Garner versus Murray. One point that we did in the class when we were doing questions, I want you to note when we are doing problems later is very simple. Whenever there is insolvency, whenever you are applying Garner versus Murray, first close realization account by finding loss, transfer it to capital, check the debit balance in capital, then you conclude that is insolvent. Then before you apply the deficiency adjustment, first receive the realization loss in cash from the partners. Receive the realization loss in cash from the partners. After you receive the realization loss, meaning one of the partner will not pay full amount, he can only pay 25 paise in a rupee or 1/3, sometimes he might not be able to pay. Then find the balancing figure in that insolvent partners column as deficiency. That you write it in the insolvent partners capital account credit side by debiting other solvent partners. Share it to solvent partners capital account debit side in capital ratio. I just gave you one summary of what you should do when you do big problems. We've done enough AQs on that for you to cover up. Then topic 7 continued. Same thing what we continuing. We discussed about insolvency of one of the partners. What if all the partners are insolvent? Or what if all partners except one is insolvent? That one solvent partner, he has debit balance in his capital account. Then what will happen? Who will cry? Then the liability holder will cry. You won't cry. So whenever the firm sells its assets, it gets cash. That cash is used to pay liabilities. What if the cash available at the beginning plus the sale of the assets plus the money recovered from solvent partners, it is together not sufficient to pay liabilities? Then what to do? Then that liability holder will not get money. That's called deficiency. What is deficiency? Cash available plus consideration from sale of assets plus collection from solvent partners together is not sufficient to pay liabilities on dissolution. Then to the extent liabilities you cannot pay, we call it deficiency. In the case of deficiency, you cannot do your normal process of transfer all assets and liabilities to realization. Why? Realization loss will become so huge that if you share that realization loss to partners capital, capital will become negative. And usually capital account balancing figure is cash. Partners capital and cash will tally. Here you can't close partners capital by cash. Why? They won't bring cash. So what to do? That is the case of deficiency. In this case what to do? Very simple. Don't transfer liabilities to realization. Don't transfer liabilities to, we discussed this in an AQ. Don't transfer liabilities to realization. This other liabilities whatever is there, don't transfer. You open one separate ledger. Asset is there, no, 1 lakh. In realization you write asset 1 lakh. Liability you don't write in realization account credit side. Instead open a separate ledger other liability account and write it there. Then you sell the assets and receive the money. Understood? Identify realization profit or loss without settlement of liabilities. Transfer it to partners capital. In cash account, you don't know how much cash is available in the beginning. Nothing. On sale of assets, how much cash did you receive? 30. That cash of 30 available will be used to pay liabilities. I'll repeat. Transfer all the assets to realization, sell the assets. Liability don't transfer to realization, open separate ledger. From cash that is available, cash account balancing figure, don't write to partners capital. Cash account balancing figure you put it to liability. You don't have enough to pay liability. Balancing figure that you get in liability is the money that you should pay but you don't have and could not pay. I'll repeat, money that you have to pay, but you don't have, so you cannot pay. This will be transferred to a separate account called deficiency account, and this deficiency will be shared to partners in profit sharing ratio. Profit sharing ratio? No. Write this other liabilities here. Partners capital account, you find individual balancing figures. That should match with this. I'll repeat, transfer all the assets to realization. Liabilities open separate ledger. Cash account, you close it by transferring the cash balance to deficiency. In deficiency, close the cash account by transferring the balance to liability. Liability, to the extent you don't pay, that will be deficiency. That deficiency should match with deficiency in capital. You wrote this realization profit or loss, that you will transfer to partners capital. In partners capital, there is shortage, that they should bring in cash, but they can't bring. Individual amounts you ignore. Total of the deficiency in partners capital should match with total of the deficiency in deficiency account. You get this? You look at this example peacefully later, you will definitely understand. I have slowed it down and aram se I have given it. You guys understand this? Usually partners capital account and cash account will match, no? In dissolution. Here cash they can't bring. So what do? Partners capital account has to match with cash, but cash they won't bring. Whatever cash is there, you put to liability. Liability balancing figure deficiency. Deficiency and capital will match. What is deficiency? Cash that they should bring, but they cannot bring. What is deficiency? Cash they should bring, but they cannot bring. That will match with the cash that they don't bring in capital. Capital is negative 10, deficiency is 10. That matches, and we've closed the accounts. Good one. There's a question on this in the study material. You can try that as well. So that's our topic 7, which talks with insolvency of individual partner, Garner versus Murray, insolvency of all the partners, deficiency account. If all the partners are insolvent, then the firm is insolvent. If all the partners are insolvent, then the firm is, we discuss this. Then we'll go to 8th topic, which is piecemeal distribution of cash. See, usually you like preparation of realization account, partners capital account, cash account, but that happens at the end, when you sold all the assets, when you paid all the liabilities, when you know full cash position and capital position. At the end you do that. That is like final accounts. But imagine your sole proprietorship concern. To do final accounts, you need trial balance. Am I right? You like opening the trading account, right? Opening stock purchase, sales, closing stock, GPO, so nice. But to do that final accounts, you need trial balance. To do trial balance, you need ledger. To do ledger, you need journal and subsidiary book. To do that, you need to identify transaction. Throughout the year, you do identifying the transaction, recording, journal, subsidiary book, ledger, trial balance. End of the year, you do final accounts. So realization account, cash book and partners capital account is end of the year business. End of the year business, meaning what? That is what we do when everything is available. But gradually when you keep selling the assets throughout the year, this month I sold one asset, next month I sold one asset, third month I sold one asset, will we keep all the money with us and tell the liability holders, I will not pay now. After I sell all the assets, I will pay. Can you tell that? No, that's too late to say. So you gradually start paying. That's piecemeal. You can't eat full chapati at once. You cut it into small pieces and eat small pieces at a time. All the assets cannot be sold in slump sale at once because no one is willing to buy. You sell one asset, you got little money, you pay little liability. You sold one more asset, you got little money, you pay little liability. Do we do piecemeal or realization? In reality, during the process you do piecemeal, at the end of the process you do realization. During the match you see live match, ball to ball, at the end of the match you see highlights. It's like that. Entire realization, partners capital account and cash account is like highlights. This is piecemeal, is like what's happening throughout. Are you getting it? This is again reference to section 48, order of settlement. First you pay outside liabilities. First you sell assets, then you pay outside liabilities, then you pay advances of partners, then you pay partners capital. When you pay outside liabilities, when you pay partners loans and advances, there is no method, it's the same. And all the outside liabilities have same priority. If you have creditors bank loan, 10,000 and 15,000, whom do you pay first? In 1:1.5 ratio, you pay both. There is nobody has priority over the other. After you pay outside liabilities, then you pay partners loan. After that, when you're paying partners, then you have two options. What are the two options? Maximum loss method, highest relative surplus capital method. How many options do you have? Maximum loss method, highest relative surplus capital method. How do we apply the methods? Very simple, yeah. Maximum loss method, we will compute how much is loss. We will compute how much is loss. How much money they will not get. How much money they will not get if you find. How much money they will get is balancing figure. Capital to be paid minus loss that I won't pay. Amount to be paid will be found as balancing figure. That is maximum loss. It's a pessimistic approach. Whereas, how do we do it under highest relative capital method? Very simple. Here, we don't compute loss. We will compute the amount that we should pay. We will compute the amount that we should pay. If I say capital is this much I will pay if I compute. What I will not pay is found as balancing figure. You understood what is the difference between these two? If I prepare a partner's capital account, amount payable to partners is on the credit. If I compute loss, write it, then I will find balancing figure as amount paid. It is maximum loss method. What method is this? Under highest relative surplus capital method, what will I do? I know the amount to be paid. I will compute the amount I will pay based on the availability. I will find loss as balancing figure. This is highest relative surplus capital method. In order to do, what do you say, maximum loss, out of the amount available, amount payable, deduct the amount available, you will get loss, share the loss in profit sharing ratio. Balancing figure will be amount to be paid. Under this, what do? Write the capitals, write the ratio, divide capital by ratio, you will get capital per share. Keep that and find surplus, deduct it from the capital. Then you will understand what is the surplus, relative and absolute, and first pay absolute surplus, then pay relative surplus, then pay capital as per base. For those who are watching it online, if in case you find this very tricky, I will pin another link, one question on maximum loss, one question on highest relative surplus capital method. If not, please do ask me in the comments and I will share one question on each for you to practice. That's with regard to piecemeal. By this we finish our piecemeal distribution. Both the methods are same, by the way. Answer will be exact same. But in the exam they will ask one of them. Whatever they mention, please try that. Then after that we come to the last part of our chapter, which is dissolution of limited liability partnership. Now let's discuss topic 9, which is dissolution of limited liability partnership. This is regulated by section 63 and 65, 63, 64, 65, not of Partnership Act but of LLP Act. Which Act? LLP Act, Limited Liability Partnership Act. So what does this say? See, like how we dissolve partnership firm, 3 people cannot sit in the room and then discuss and decide. For LLP dissolution, you have to take order from the court. You have to take permission from the regulating authority, MCA. You can't decide it just like that and then the firm is dissolved. Even if you take a decision, you would have to take consent from the tribunal or court, basically NCLT. Till then it's not wound up. Compulsorily also it can be wound up by NCLT. Voluntarily you can also decide, or your liability are there, no creditors, they can also decide and push for it. The only difference between limited liability partnership dissolution and partnership dissolution is the liability of the partners are limited. Rama, Bhima, Soma are partners. If the firm does not have enough money to pay liabilities, Rama, Bhima or Soma, neither of them are supposed to get extra money. They are not required to. Why? The liability is limited. Personal assets of the partner are liable or not liable. Personal assets of the partner are not liable to pay the debts of the firm. In no case will they bring in their personal assets money unless it is their default. It is their willful misconduct. Because of that, the firm is going into this situation. In that case, they can be sued. Otherwise, the personal assets of the partner are not liable to pay the dues of the firm. I have given difference between firm and LLP and how the dissolution will be slightly different. There is one question on this in the ICA study material, question number 9 if I am not wrong. Please do that, and I hope you people will be really comfortable and ready to ace questions in the exam on dissolution of partnership.